Look at the date on your screen. It is Friday, January 2nd, 2026. The markets have been open for less than 48 hours since New Year's, and the CME Group just pulled the trigger again. For the third time in 7 days, they have raised margin requirements on silver futures contracts. This is not normal. This is not standard risk management. This is a coordinated squeeze designed to force one specific group of people out of the market. And if you don't understand the mechanics of what's happening right now, you could be the next person liquidated. Let me give you the numbers. On December 27th, the margin requirement to hold one silver futures contract was 22,000. That's what you needed in your account to control 5,000 ounces of paper silver. Then on December 31st, at 4 p.m. Eastern, the CME announced margin hike number 1. They raised it 13.5 to 25,000 per contract. Traders who woke up on New Year's Day suddenly needed an extra 3,000 per contract or their positions would be automatically closed. But it didn't stop there. On January 2nd, less than 48 hours later, the CME announced margin hike number 2. They raised it another 30, from 25,000 to 32,500 per contract. That is a 48 increase in total margin requirements in just 1 week. Let me repeat that. If you were holding a silver futures contract on December 27th, you needed 22,000 in your account. Today, January 3rd, you need 32,500 for that exact same position. That is an additional 10,500 in cash that you must deposit immediately, or your broker will close your position without asking permission. Now, if you're watching this and thinking this is just standard volatility management, let me show you why you're wrong. The CME has a formula. When volatility increases, they raise margins to protect the clearinghouse. That makes sense on paper. But here's what they don't tell you. The timing of these hikes is not random. They are surgical. They are designed to hit at the exact moment when the maximum number of traders are most vulnerable. Think about the calendar. December 31st. That is the last trading day of the year. Volume is at its lowest. Liquidity has dried up. Most institutional traders have closed their books and gone home. Retail traders are with family. And that is when the CME announces the first hike. Why? Because in thin markets, margin hikes cause forced liquidation, and forced liquidation causes price crashes. The price crashes from 75 to 70. Stops get triggered. Panic spreads. And the people who have to sell are selling into a market with no buyers, so they get terrible prices. Then, 48 hours later, January 2nd, they do it again. Why? Because traders who survived the first hike are now over-leveraged. They used all their available cash to meet the first margin call. They have nothing left. So when the second hike hits, they are mathematically forced to sell. They don't have a choice. Their broker liquidates them automatically. And every forced sale pushes the price lower, which triggers more stops, which causes more liquidation. This is the trap. But here's the part that makes this truly insidious. Who benefits from this? Not retail traders. Retail traders are the ones getting margin called, not small hedge funds. They are getting squeezed too. The only entities that benefit from this are the large institutions that are short silver, the bullion banks, the market makers, the entities that sold silver at 75 and are now desperate to buy it back at 70. When you get margin called and your position is closed at 70, guess who is on the other side of that trade buying your contract? The same banks that lobbied the CME to raise the margins in the first place. Let me walk you through the exact mechanics of how this works, because this is not a theory. This is documented. You have a silver position. You bought at 72. You put up the required 22,000 margin. Silver rallies to 75. You're in profit. You're feeling good. Then December 31st hits. CME raises margins to 25,000. Your broker sends you a margin call notice. You have until market open on January 2nd to deposit 3,000 or your position will be closed. Now, most retail traders don't keep extra cash sitting in their brokerage account. They are fully invested. So they have 2 choices. Choice 1, sell something else to raise the cash. But it's New Year's. The markets are closed. You can't sell. Choice 2, wire money from your bank. But it's a holiday. Banks are closed. Wires don't process until January 2nd. By the time your money arrives, the second margin hike has been announced. Now you need 32,500 instead of 25,000. You don't have it. Your broker liquidates your position automatically at whatever the market price is. You had no say in the matter. And here's the truly evil part. Your position was liquidated at 70. You bought at 72. So you took a 2 loss per ounce times 5,000 ounces. That's a 10,000 loss on paper. But in reality, you lost 20,000. Why? Because you also had to pay the extra margin. You deposited 3,000 for the first hike, lost 10,000 on the position, and had your 22,000 initial margin tied up. The total capital you burned through was massive. And all of this happened not because silver collapsed due to fundamentals, but because the CME changed the rules mid-game. Now, let me show you the pattern, because this is not the first time they have done this. In April 2011, silver was trading at 49. It was on a parabolic run toward 50. Everyone was talking about the silver squeeze. Retail traders were piling in. And then the CME raised margins. 5 times in 8 days. They raised margins 5 times. Each hike triggered forced selling. The price crashed from 49 to 32 in 2 weeks. A 35 collapse. Was that because silver fundamentals changed? No. It was because the CME weaponized margin requirements to break the rally and protect the short sellers. They are doing it again right now. Same playbook, same tactics, different year. The only difference is that this time, the fundamentals are even more bullish. This time, there's a real physical shortage. This time, China has locked down exports. This time, industrial buyers are panic buying, and the bullion banks are more desperate than ever. So the margin hikes are coming faster and harder. Let me tell you what's coming next, because if you understand the pattern, you can protect yourself. The CME will likely announce a third margin hike within the next 48 to 72 hours. Why? Because the price is stabilizing. Silver bounced back from 70 to 76. That means the shorts are still underwater. They need another wave of forced selling to push it lower. So the CME will raise margins again. Maybe to 40,000 per contract. Maybe to 45,000. It doesn't matter. The goal is the same. Force out the leveraged longs. Clear the deck for the shorts to cover at lower prices. Let me give you the timeline for what happens next. Phase 1 is what we are in right now. Margin hikes, forced liquidation, paper price crashes while physical holds steady. This phase lasts maybe another week or 2. Phase 2 is when the COMEX runs out of deliverable silver. They will declare force majeure. They will offer cash settlement instead of metal. And the paper market will completely lose credibility. Phase 3 is when the physical market becomes the only market. The price will be whatever dealers and refiners say it is. And if you don't own physical metal by then, you will be priced out. So here's my final message. Do not let the margin hikes scare you out of your conviction. Do not let the paper price crashes make you think the bull market is over. The fundamentals have not changed. The shortage is real. The industrial demand is real. The China export ban is real. The only thing that changed is that the CME raised some arbitrary numbers in a computer system to protect their short-selling friends. That has nothing to do with the value of silver. If you own physical metal, you are in the right position. If you are trading on leverage, you are playing a dangerous game that you cannot win. And if you are sitting on the sidelines waiting for a better entry point, understand that every day you wait, the physical premium gets wider. Every day you wait, the supply gets tighter. The repricing is happening right now. The paper market is just the last one to admit it. This is global market files. The margin hikes will continue. The liquidations will continue. But the physical shortage will continue too. And in the end, physics beats paper. Hold your position. Trust your thesis. And I will see you in the next update.